Hello everyone, today is Friday, August 19th, 2022. My name is Evan. Welcome back to another edition of Stock Market Weekly, episode 645, presented by the Trade Risk, where it is our job to break down the most important trends, price action, and noteworthy moves that you may have missed across financial markets this week. If you're brand new to this video series, welcome. Thanks for tuning in. Thanks for joining us. Here's how these videos work. We break up our analysis into two parts. In part one, we look through the numbers, we pick apart everything that stands out, looks different, interesting, or notable. And then in part two, we jump into the charts, we take a look at price action, a very detailed, close lens, and then observe the current market trends and just basically try and position ourselves best looking ahead. So hopefully that sounds good to you. Let's jump into some of the takeaways from this week. First and foremost, stock market finally taking a breather, a well-deserved breather in my opinion. We have been really sort of just grinding or frankly launching higher over the past about 6 weeks, 7 weeks or so. And so stocks finally put in a bit of an outside reversal week. It was OPEX week. So there's a couple of cross currents and interesting dynamics going on. But we also had the US dollar, which was really strong this week. I mean, it came surging back and in fact made new weekly closing index highs. This was one of the risks that we sort of outlined last week, was keeping an eye on the dollar, keeping an eye on interest rates, both of those flaring up this week. And of course, you know, stock market showing what it thinks about that. Defensive stocks were getting breakouts across the board. We're going to look at some individual names in part two. We're going to look at some leading risk indicators here. So we've got a couple of charts that we're going to look at in part two here to sort of break down whether or not this is going to be a more sustained pullback or if this is going to be something that's opportunistic to buy into. And then we're also going to take a closer look at the number of stocks, percentage of stocks over 50 SMA. So lots of good stuff in this video. Let's look at some of the numbers here. So right-hand column, 1 week change here. Everything in the red. S&P fared best on a relative basis, down 1.21%. The Russell 2000 was down almost 3%. Nasdaq was in the middle here. You can see the 1 month numbers still very green for the US markets here, and world stocks a little less green, but world stocks minus United States still up over the past 1 month. So again, giving back a little bit of the rally that we've seen here. Now, if we take a look at the trends overall here, our short and medium term trends just dictated very simple here by the 10 SMA and the 50 SMA, the slopes, whether or not they're rising or declining. We still have rising 10 and 50 SMAs across the board for US indices. World stocks were both declining here. So ACWX is our proxy for that. And we're basically still declining across the board, showing some of that relative weakness. The 200 SMA long-term still declining across the board as well. Now, in terms of volatility here, this is what's pretty interesting because yes, we finally did get the market to turn around and to see a few days of selling pressure, but notice where the VIX is here. So unlike in prior sort of sell-offs where the floor for VIX or the trading range for VIX was more in the upper 20s or even lower 30s at some point, we're now seeing a lower floor here. So after a few days of selling, and of course we had OPEX today as well on Friday, we still have the VIX just sitting at 20.6. So again, these are much more subdued volatility levels than we've seen earlier in the year. The Nasdaq volatility index 26.74. And again, what's pretty remarkable is that on the week, though I do think we've got, yes, on the week here, they were up slightly. Yes, well, up 1.56%. That checks out. Not percentage, but just actual points. Okay. Couple of charts here that are not part of our research. So I pulled this from Nautilus Cap on Twitter. So this is their research here, not mine. But I thought this was kind of funny and you know, shows some of the biases that we can all have here. What this chart is showing us, and you can hit pause on this and just look a little bit closer, are just these four different analogs of current price action overlaid on prior years. So this is S&P this year versus 1962. And again, you can see that this chart would basically lead us to believe that we are in store for a bit of a pullback here in the coming month or so, and then we're going to be off to the races with this new bull rally. If you look at this chart down here in 2015, well, maybe some sideways chop, a pullback, and then off to the races. And then you have the pessimistic charts, right? So you have the bearish analogs here of 2008. Well, if we overlay this over 2008, you can see that we're about to be in store for the next leg down, which is going to cascade us lower for new recent lows. And then if you look at 1973, basically similar comments. So this is what's interesting, when you start to look at these analogs just based on small occurrences and small sample sets. I do like this generally speaking. I don't personally, trade off of this. This is not, a way that I would just look at any one of these and say, oh yes, this is definitely 1962. Let's just buy everything. So I think that, looking at historical context is just that. It's context, it's clues. It can give you some evidence. It can give you a potential path, but I think you need to supplement it with other things. And that's obviously what we try and do here each and every week. But again, Nautilus Cap, check out their research, and they are publishing some pretty good stuff over there. And then I also have this advisorperspectives.com. Again, not my research. I'm borrowing this chart. So again, full credit to the sources here. But I thought this was interesting as well. This is margin debt overlaid, and these are adjusted for inflation and looking at kind of money supply or present day dollars. Again, I'm not 100% sure on how they're normalizing these values, but what this I think is showing nicely here is just that margin debt. And the way you can think of this is purely, as a sort of a speculation, right? So higher margin debt basically means more frenzy in the market, more people out there borrowing money, getting excited, buying stocks with it. And when we look at very low levels like we have here, this red line, you can see that this is basically when everybody sort of hates the market or is not that invested or certainly not that leveraged or excited about the market. And so again, this just shows some historical context here. And when the red line is sort of below the blue line, you could consider that to be, again, very simple view here, but in some type of value zone or sentiment is clearly speaking to why margin debt is below the blue S&P 500 price chart. So again, something else to just look at. I thought was interesting. So hit pause and review that. Now, if we get back to the numbers here and we start to put some of those things into context and we start looking at market breadth, NYSE 52-week highs and lows, we like to track this every single week. And we did have another week of more stocks hitting more highs than lows. So this is something that we've been wanting to see increase, right? We've been looking at this ratio. It started to, it went from steeply declining to basically even, just kind of treading water sideways. And then over the past couple of weeks, we're finally starting to see the pickup a little bit more in the number of stocks hitting 52-week highs. Again, they're not great numbers. They're not triple-digit numbers on the number of stocks hitting 52-week highs, but we're finally starting to, again, just tread water / get into the right bullish direction if you are a bull on this market. Sector performance this week was mostly negative. We had consumer staples at the top of the list, again, almost 2%, utilities in the second spot, and energy in the third spot. Very defensive sort of tone to the market. And then healthcare, of course, in the fourth spot, but it was red. On the downside, it was communication services, materials, and real estate. Those are the three underperformers, but most of the sectors were red. Again, if you look at the middle column here, this is the 1 month return numbers. So again, you can see that the market has been extremely hot and is starting to dial back that froth. Now, 10-day correlations, there's still not a whole lot of change here. So we've been looking at these. I'm going to just let you hit pause and look at this table. There's nothing new that really jumps out to me this week, based on kind of what these numbers have been showing us recently. Now, Treasury yields, this is the problem right now, is the fact that interest rates are just, climbing higher again and starting to actually jump higher. So the 10-year yield, which was, 3 weeks ago, under 2.7, is now back to that big 3% psychological level. It's nearly there. And so we continue to see these treasury yields inch higher. And as we sort of talked about in terms of risks or what can derail this market rally, it was exactly this. If we continue, if we start to see interest rates start to really ramp back up, then that poses, mostly a risk to the high risk, the growth side of the market. And that's definitely what we've seen basically play out here over the next over this week. Now, if we take a look here at dollar and commodities, we did have basically one commodity. Well, and we're certainly not tracking all commodities. We're using a summed up view, but natural gas was bucking the trend this week. So the dollar index was up 2.41%. It's a massive, massive move here for the dollar index. And we did see natural gas still manage to make headway to the upside this week, up almost 6%. Crude oil actually did pretty well, though, all things considered, down 1%. Agriculture was down almost 3%. Gold down 3%. Silver really getting hit hard this week, 8% to the downside. And then Bitcoin, of course, down 13%, giving back a lot of this month's rally. So that is it for our free edition of this week's Stock Market Weekly video. If you would like to continue on, we are about to jump into a lot of charts. We're going to analyze price action. We're going to look at some key levels that we're paying attention to this week. We're also got some of that advanced sort of market internal data that we're going to be looking at, as well as some individual stocks. So lots of good stuff. You can head to thetraderist.com/SMW. If you're not already there, you can buy this episode for just $5, catch the full length extended version, or you can subscribe and save $15 a month. That gets you access to the extended version of these videos, help you trade smarter, hopefully, and navigate these markets. So that is it for the free version. Again, thanks everyone for dropping off here, and we hope to see you back here next week. Have a great weekend.